If you have an interview these days, chances are you will be asked about the yield curve inversion. And that is because this is something that doesn't happen very often and is kind of a big deal. But first things first, what is a yield curve? Well, it's a curve showing for different yields on the y-axis for different maturities on the horizontal axis for government bonds. So this is what investors expect to receive in terms of income when they lend to governments for different periods of time. So in this chart, we can see that the average yield to maturity on a 2-year government bond in the US is 2.5%. Every country has a yield curve and they usually point up, so they're upward sloping. And that's because if you lend for a longer maturity, say 30 years, then you expect a higher compensation than what you could get, for example, on a 2-year loan. And that's because you're locking your capital for a longer period of time. So this curve, which reflects supply and demand of government bonds, tells me roughly what the market thinks yields will be in 5, 10, and even 30 years' time. Now, just because we think that something's going to happen, it doesn't mean that it actually happens. But nevertheless, it's super interesting to look at this thing because it shows investor sentiment, and the market is made of investors. Sometimes it can happen that the yield curve inverts, it changes shape and it points downward, so that the yield on shorter maturities like 3 months rises above the yield on longer duration bonds such as 10 and 30 years. And when this happens, most of the times a recession comes in the following 12 months. Why would this be? Well, since the yield curve is like a barometer of investor sentiment, it tells me that the market expects lower rates in the future compared to today. And this is usually because investors believe that central banks will have to lower interest rates in the future to encourage spending and save the economy from recession. Since the 1970s, a yield curve inversion has predicted US recession quite reliably, with a few false positives. For example, the last time that the yield curve inverted was in 2019. And although it's true that we had a recession because of the pandemic, I find it very hard to believe that investors predicted COVID-19 and its effects on the world economy. So there are reasons to think that this time it might also be different. It could be that investors think that the Fed has to keep short-term interest rates very high to fight inflation, which is the highest we've seen since the 70s, but they also believe that inflation might recede and normalize in the medium term. At least this is what the equity market is telling us, because equities are going pretty strong despite what's happening in the world at the moment. So if this happens, central banks will be able to reduce interest rates and bring them to the lower level that we've seen for the past decade or so. So that was everything for today. I hope you found this video useful and you're going to use it in your next interview. If you do, please let me know. It always makes me happy to know these things. And thanks so much for watching. I'll catch you soon.